Introduction. Financial statements are the core output of the accounting process. They provide a structured representation of an organization's financial position and performance over a specific period. These statements are not just for accountants, they are essential tools for investors, managers, creditors, regulators, and other stakeholders. In this module, we will explore the four primary financial statements, how they are prepared, what each conveys, and how to interpret their contents to support informed financial decision making. The four key financial statements: the income statement, profit and loss statement, the balance sheet, statement of financial position, the statement of cash flows, the statement of changes in equity. Each serves a distinct function in presenting financial data, and together they offer a complete view of an organization's financial health. The income statement. Definition. The income statement shows a company's revenues, expenses, and profits or losses over a specific period, monthly, quarterly, annually. Format. Income statement for XYZ Ltd. Year ending December 31st. Revenue 10 million naira. COGS 6 million naira. Gross profit 4 million naira. Operating expenses 1,500,000 naira. Operating profit 2,500,000 naira. Tax and interest 500,000 naira. Net profit 2 million naira. Purpose: measures profitability over time. Evaluates cost structure and performance efficiency. Used for budget comparisons and trend analysis. Interpretation. Tips. Look at gross margin and net margin. Compare growth across time periods. Analyze major expenses versus revenue trends.
The balance sheet. Definition. The balance sheet presents a snapshot of a company's assets, liabilities, and equity at a specific point in time. Basic equation: assets equals liabilities plus equity format. Balance sheet as at December 31st. Assets: cash 1 million naira, inventory 2 million naira, equipment net 5 million naira, total assets 8 million naira, liabilities: accounts payable $9,500,000, bank loan and $2,500,000, total liabilities N for million, equity, owner's capital N 3 million, retained earnings none million, total equity 4 million naira, total liabilities plus equity 8 million naira. Purpose: displays financial position and stability, shows liquidity and solvency, supports investment and lending decisions. Interpretation tips: assess the debt-to-equity ratio, evaluate asset structure, fixed versus current, track working capital, current assets minus current liabilities.
The statement of cash flows. Definition. This statement reports the actual cash inflows and outflows from operating, investing, and financing activities. 3 sections: operating activities, cash from daily operations; investing activities, buying, selling assets; financing activities, capital from owners or lenders. Format: simplified. Cash flow statement amount: naira. Operating activities plus 1 million. Naira investing activities minus 500,000 naira. Financing activities plus 200,000 naira. Net increase in cash 700,000 naira. Purpose: measures cash generation and usage. Assesses ability to meet obligations. Validates accrual profits with cash availability. Interpretation. Tips: positive operating cash flow equals good. Negative investing equals likely asset acquisition. Large financing inflows equals possible new debt or equity. The statement of changes in equity. Definition. This statement shows movements in equity accounts, including owner contributions, withdrawals, net profit, and dividend payouts. Format. In this course, we will be using equity statement, excerpt, and amount naira for our table. 1. Opening equity 3 million naira. 2. Plus net income 1,200,000 naira. 3. Minus dividend 200,000 naira. 4. Plus capital injection 500,000 naira. 5. Closing equity 6. 4,500,000 naira 7. Purpose: tracks value retained in business. Highlights changes from profits and owner activity. Useful for investment evaluation. Interrelationship of financial statements. Net income from the income statement flows into retained earnings on the balance sheet and into the cash flow statement under operating activities. Closing cash in the cash flow statement matches the cash balance on the balance sheet. Equity changes a line across the balance sheet and statement of changes in equity. Understanding how statements interlink is vital to spotting inconsistencies and gaining a full picture of financial health. Key financial ratios for interpretation. In this course, we will be using ratio, formula, and insight in our table. 1. Current ratio. Current assets. Current liabilities liquidity. 2. Quick ratio. Current assets inventory. Current liabilities. Short-term solvency. 3. Debt to equity. Total liabilities/equity. Leverage 4. Gross profit margin. Gross profit/revenue. Cost efficiency 5. Net profit margin. Net income/revenue profitability 6. Return on equity. ROE. Net income. Equity shareholder return. 7. Asset turnover revenue. Total assets efficiency of asset use. Common financial statement misinterpretations. Over-reliance on net profit. Profits may not reflect actual cash flows. Ignoring footnotes. Disclosures often hide liabilities or contingencies. Looking at one period only. Always compare over multiple periods. Confusing profit with liquidity. Profitable firms can still face cash shortages. Summary. This module provided a thorough understanding of the 4 major financial statements and how to interpret them effectively. Whether you're an aspiring accountant, business owner, or investor, the ability to read and analyze financial statements is a critical skill that empowers you to make data-driven financial decisions.